The OECD upgrades global growth but cuts its forecast for the UK. Welcome to Market Insight, I'm Ramzan Karmali. The good news is the global economy is growing faster than the OECD expected just a few months ago. That's thanks to resilient activity in the US. The bad news for the UK at least was growth was downgraded to just 0.4% this year. Well, to look at the OECD latest economic outlook in more detail and much more, I'm joined by Fiona Cincotta, market analyst at City Index. Fiona, thanks so much for joining us. So why is the OECD so down on the UK?
Yeah, I mean, this is disappointing, the downward revision, but it follows in line with the IMF, so I guess it maybe isn't that surprising. And I think what we're seeing here are concerns about the sort of sticky level of inflation, but perhaps more particularly the sticky level of service sector inflation, which that coupled with a shortage of skilled staff seems to be driving concerns about the growth outlook for the UK. I mean, the inflation forecast from the OECD for 2024 is 2.7%. So that's still particularly a decent point above the Bank of England's 2% target. So I think, they also suggest that perhaps the Bank of England won't be looking to cut rates until the third quarter of this year. So again, if we're going to have to be waiting that little bit longer for the Bank of England to be cutting interest rates, then it could mean that sort of growth does remain under pressure.
Also, Germany got singled out as a reason behind the whole of the Eurozone possibly having weak growth this year. We also had pretty tame manufacturing PMI out as well. So is the main reason behind this forecast being so poor for the Eurozone in total, down to manufacturing alone?
No, I don't think it's down to manufacturing alone, but I do think that the manufacturing is playing a large part here. We do know that sort of across the board that in Germany there has been weakness, not just in manufacturing, but we've seen the households have been under pressure as well. And it's only recently that we're starting to see a rebound in the services sector. And so, I think there is sort of this sign that the Eurozone economy has been weaker, particularly towards the end of last year. But I think there are signs that we're getting moving forward, that there could be a rebound in the economy, but that'll probably be more thanks to a recovery in the service sector. I think for any real recovery in manufacturing, we're just going to have to be a little bit more patient. Those figures do remain really quite firmly in the contraction territory at the moment.
Now, overnight, the Fed kept rates on hold as expected, but inflation in the US still remains sticky. Have you changed your mind about whether we'll get rate cuts this year at all?
Yeah, I mean, that is the big question, and I think that was the question that Federal Reserve Jerome Powell was just trying to calm fears that, the Federal Reserve may hike interest rates this year. And I think that's what he intended to do. And it seems like the market sort of took that on board. We saw the US dollar fall yesterday, and we've seen the futures pushing higher today. But I mean, I think at the end of the day, it is a matter of rates are going to stay high for longer in the US. There's nothing really coming through in the data just yet that really screams the Fed needs to start cutting interest rates. Inflation rose across the first quarter. We've seen labour costs are also high. Rising, and we've also seen this resilience in the jobs market. So, as I said, there's nothing really out there just yet that's saying to the Fed, you must be cutting rates. And with that in mind, I think there is, a reason to think that there might not be actually any rate cuts until November this year, or potentially if we see inflation continue to remain sticky, it could be pushed into 2025.
So Shell had results out this morning and they beat market estimates, but they were nowhere near this time last year. So should investors be worried?
Yeah, it's a really good point. These were better than expected numbers from Shell, but they were down on last year's. And, that's a trend that we've seen across oil majors. And that's basically if we think about where commodity prices were last year compared to this year. And, after the invasion by Russia into Ukraine that really sent, oil prices much, much higher. Then we had those concerns over energy prices, gas prices as well. So, that's all been taken out and worked its way through the market now. So that's explaining why, while we're seeing those slightly lower profits. But again, they were better than expected. As I said, we've had those disruptions in the Red Sea, which has sort of supported commodity prices across the first quarter of this year. So again, very, very strong results all the same from Shell.
Novo Nordisk had results out and they were pretty stellar from the looks of it, but shares have hardly moved. Why are the markets not impressed?
Yes, so they beat profit expectations, beat revenue expectations, upwardly revised guidance, so on. The first look, these look like really strong numbers. And I mean, a lot of this is thanks to the sort of soaring demand for Wegovy, the weight loss drug. I mean, we've seen demand soar. It's up around 35% in the US. But actually, sales of Wegovy were just slightly below forecast, despite the fact that they had doubled. And I think that's just sort of keeping the lid on demand for the shares today. And I think it also, though, just highlights how important those Wegovy sales are to the share price rally that we have seen and the future outlook for the share price.
Fiona Cincotta from City Index, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.